Methodology of financial data analysis. Part 1. Elements of the model implementation process in finance with examples. Data selection and processing. The first step in building a model is selecting the data it will work with. These could be macro or microeconomic data for analysis, evaluation, and prediction of phenomena in the business environment or within the company. They could also be market data, such as historical data on rates, returns from a particular financial instrument. The collected data must be appropriately processed and ensured to be complete and reliable. Examples of data processing include removing or filling in missing periods, standardization, or normalization. Depending on the model, data may require special processing. Selection of the appropriate model. Depending on the specific problem in economics and finance, an appropriate model must be chosen. Examples of models include multiple regression, linear regression, time series models, GARCH, Monte Carlo, VAR, machine learning algorithms, neural networks. The choice of the appropriate model depends on the analyzed event, the goal we want to achieve, and also on the available data. Testing and validation of the model. After selecting and processing the dataset and choosing an adequate model suitable for the data and the goal, it is necessary to ensure that the built model demonstrates the correctness of its operation. Predictions on historical data. By introducing historical data into the model and comparing the model's results with real data, the level of model efficiency can be established, based on which we can decide whether the model is correct and whether it meets our requirements. Effective tests for the model can include calculating the Gini coefficient or testing the ratio of positional statistics. In the case of ineffective model operation, it may be necessary to change model parameters or completely replace the model or approach used. Deployment and monitoring of the model. The tested effective model is suitable for implementation in a real environment. The deployment of the model aims to use it on real data for analysis and prediction. According to the model results, conclusions can be drawn, and the model's results can be used as an argument in the decision-making process. Monitoring the model is a continuous process aimed at ensuring the effectiveness of model work and minimizing risk. After deploying the model, it is important to continuously monitor its results because the changing market situation may lead to ineffective model operation despite its previous testing and acceptance of results. As a result of monitoring and noticing inadequate model operation and errors in results compared to real data, further adjustments may be introduced to improve the model's effectiveness. Using models for prediction and as one of the stages of investment portfolio management carries some inevitable risk that should be appropriately managed. We should diagnose even unlikely situations and prepare for their consequences. Part 2. Risk of the model in measuring value at risk, concept, and examples. Model risk. It cannot be avoided. Potential threat lies in the unawareness of the existence of this risk, its size, and consequences. In finance, model risk always exists. We check its size and estimate whether its realization would result in significant losses. Model risk in measuring value at risk refers to the uncertainty associated with the accuracy and reliability of the model used to estimate financial risk. Examples of such models include historical simulation VAR, covariance variance, Monte Carlo model. The idea of this model is to use various statistical, mathematical, and economic methods to analyze historical data and forecast future scenarios. This model is based on the assumption that past market behavior or financial instrument behavior can provide clues about future patterns or trends. Model assumptions. Risk occurs when the assumptions made by the model do not reflect reality. For example, if the model assumes a constant market behavior pattern and it suddenly changes, the model's forecasts may be incorrect. An example of inadequate risk management and erroneous model assumptions, incorrect estimation of the magnitude of certain risk variables, credit risk, is the crisis of 2008 and the collapse of Lehman Brothers, which incorrectly estimated the probability and magnitude of credit risk. Problem with the complexity of analyzed data. Market volatility, incorrect application of the model. Modeling value at risk involves forecasting future scenarios and market risk. However, financial markets are susceptible to volatility and instability, which can affect the model's results. In the event of sudden market changes, the model may not be able to adequately consider these factors. Data limitations. Model risk may result from insufficient historical data or data that are not sufficiently representative for the analyzed issue, e.g., too short a data period for a cyclical company, or which are no longer adequate due to changing market conditions. In such cases, the model may have difficulty accurately forecasting future scenarios. Modeling techniques used. The choice of techniques and methods used in modeling value at risk is associated with the risk of improper selection for the analyzed data. Inappropriate selection of form, structure, portfolio, and failure to consider all risk factors can lead to incorrect results. Human factor. Inability to adequately interpret or misunderstand processes related to the adequate implementation and utilization of the model. Example: failure to hedge SVB positions against interest rate risk. Part 3, GARCH 101. Model and its properties, conditional and unconditional volatility. The GARCH 101 model is a generalized autoregressive model that captures the phenomenon of clustering of return rate variability. Both small and large price changes tend to occur in clusters through conditional variance, as well as autocorrelation of squared residuals. It is the most commonly used model for the volatility of financial instruments. This model allows describing the effect of volatility clustering and fat-tailed distribution. The GARCH 111 model helps us understand and predict how the volatility of something like stock prices or financial returns changes over time. It looks at how past volatility and the difference between expected and actual values affect future volatility. Properties. The autocorrelation function of squared residuals decreases exponentially. Modeling the memory of volatility model, modeling the clustering effect of data, modeling leverage effect, modeling the mean reversion effect. Part 4. Monte Carlo method with dispersion reduction technique. The method of mirror reflections involves reflecting data around a certain axis, similar to a mirror reflection. We choose an axis around which we want to reflect our data and create symmetric copies of that data on the other side of the axis. We then analyze these symmetric copies and compare them to the original data. If there is any pattern or structure in the data, they should manifest as repeated symmetric patterns on both sides of the axis. Understanding the data. Before running the simulation, we need to understand the historical data. We look for any patterns or trends that may exist in the data. The method of mirror reflections allows us to identify any symmetric patterns in the data, which can help us make better predictions. By reducing dispersion in this manner, we can improve the accuracy of our predictions and better understand the range of possible outcomes. It helps us consider different scenarios and make more informed decisions based on a comprehensive analysis of financial data. By using the method of mirror reflections to analyze the results of a Monte Carlo simulation, we can uncover patterns, relationships, and biases in the data. Part 5. Properties of financial time series and methods of modeling them. A time series is an ordered sequence of observations showing the evolution of a phenomenon over successive time periods. Time series are modeled to reflect the complex reality they represent, enabling the observation, examination, and analysis of phenomena occurring within them, as well as understanding and forecasting them. A model is an approximation of reality and should therefore accurately represent it. An econometric model is a construction that, through one equation or a system of equations, depicts the relationship of a phenomenon to other phenomena that explain it, including past levels of the analyzed phenomenon itself. Time series are modeled for purposes such as measuring risk, valuing financial instruments, portfolio construction and hedging, forecasting the future. Part 6. Properties of financial time series models. Trend. The trend represents the long-term direction or movement of a time series. It captures the overall upward or downward movement over an extended period. Trends can be linear, indicating a steady increase or decrease, or nonlinear, exhibiting more complex patterns. Identifying and modeling the trend component is important for forecasting future values. Seasonality. Seasonality refers to regular and predictable patterns that occur within a specific time frame, such as daily, weekly, or yearly cycles. Many financial time series exhibit seasonal effects due to factors like calendar events, holidays, or economic cycles. Accounting for seasonality helps identify recurring patterns and understand the potential impact of these cycles on future outcomes. Volatility. Volatility refers to the degree of variation or dispersion in the prices or returns of a financial asset. It measures the level of uncertainty or risk associated with the time series. Volatility is essential for risk management, option pricing, and portfolio optimization. Various statistical models, such as GARCH, generalized autoregressive conditional heteroscedasticity, are commonly used to capture and predict volatility. Autocorrelation. Autocorrelation helps us understand patterns and relationships in numbers over time. Autocorrelation, or serial correlation, is the correlation between a time series and its lagged values. In financial time series, this means that the current value may be influenced by previous values. Autocorrelation analysis helps identify patterns such as momentum or mean reversion and is essential for developing autoregressive models like ARMA, autoregressive moving average, or ARIMA, autoregressive integrated moving average. Non-stationarity. Non-stationarity refers to the violation of the assumption that the statistical properties of a time series remain constant over time. Many financial time series exhibit non-stationarity due to trends, seasonality, or structural breaks. To model non-stationary series, techniques like differencing, which transforms the data into a stationary form, or models like the ARIMA model, are commonly employed. Part 7. Ways of modeling, examples of time series. Autoregression models AR, linear dependencies in return series. Moving average models MA, linear dependencies in return series. ARMA models, linear dependencies in returnees, modeling expected values of individual series. Heteroscedasticity, a regular pattern of variability in a statistical model. For ARCH models, modeling conditional heteroscedasticity, all ARCH class models enable the description of fat tails and the clustering effect of variability. GARCH models, modeling conditional heteroscedasticity, describing the accumulation of variability and autocorrelation of squared residuals. Statistical models for time series, autoregressive models. AR assumes that the past predicts the future. In a given series, the value at time t is a function of values at earlier time points. Autoregression is regression based on past values to predict future values. Moving average models. MA assumes that the value at a given time point is described by the function of recent values. Integrated autoregressive moving average models. ARIMA, a combination of AR and MA properties plus elimination of trend and introduction of stationarity. Part 8. Backtesting VR models, concepts and challenges. To conduct backtesting, historical data, such as stock prices or other financial assets, is utilized alongside the VR model to estimate potential losses. These estimates are then compared to the actual outcomes during that period. If the predictions closely match the actual results, it indicates that the VR model is performing well. However, significant differences may suggest that adjustments to the model are necessary. Challenges in backtesting VR models arise from the fact that the future may not always mirror the past, and unforeseen events can occur. Backtesting involves evaluating models by comparing forecasts with past events they aim to predict. Methods for assessing the accuracy of VR models involve verifying whether the applied model still fulfills its role in indicating the level and changes in risk. Stress tests. These tests complement VR results and can serve as tools for expert verification of VR models. They evaluate extreme condition scenarios. During backtesting, two types of errors can occur. I. Type 1 error, accepting an incorrect model when there is no basis for rejecting it. 2. Type 2 error, rejecting a model when it is correct. Best tests. 7. Gini coefficient test. The Lorenz curve represents the distribution of a variable. Comparing it to the line of perfect equality assesses how accurately the VR model predicts risks. The area between the Lorenz curve and the line of perfect equality is used to calculate the Gini coefficient, providing a numerical summary of inequality. 8. Test of the ratio of positional statistics. All values are sorted in ascending order and assigned ranks. Comparing the ranks of estimated and real data values helps determine if the model's predictions are lower than the actual data. Time series models are extremely useful in financial analysis because they allow us to look at data from many different perspectives and understand complex relationships between them. For example, We can use these models to examine how changes in interest rates affect stock prices or how inflation affects bond yields. This enables us to better understand the risks and opportunities associated with our investments and make more informed decisions. One of the most common applications of multivariate time series models in finance is the analysis of investment portfolios. We can use these models to study how various financial assets, such as stocks, bonds, or commodities, behave under different market conditions and how changes in one asset can affect others. This allows us to optimize our investment portfolio, minimizing risk while maintaining an appropriate level of return. Another important application is forecasting future trends in financial markets. By using historical data and multivariate time series models, we can attempt to predict future asset prices. This enables investors to make better informed investment decisions and avoid unnecessary risks. Finally, multivariate time series models are also used for financial risk management. By analyzing complex relationships between various risk factors, such as asset price volatility or changes in interest rates, we can identify areas that may be exposed to significant risk and take appropriate actions to minimize it. However, it is important to remember that analyzing multivariate time series requires proper data preparation and advanced statistical analysis tools. It is also worth noting that these models are not perfect and have their limitations. Nevertheless, they are extremely useful in financial analysis and can help us better understand the dynamics of financial markets and make more informed investment decisions.